All right, let's finish up our chapter on receivables by looking at what we call notes receivable. And it says here on our slide that a note receivable does have some advantages over an account receivable. And primarily, the advantage is that a note receivable results in a stronger legal claim. Okay, the note receivable is more of an overall formal document, formal note. An account receivable is a trade type note, and these are, if someone doesn't pay you the amount that they owe you for an account receivable, as a business owner, you can take that business to court, but the note receivable is structured in a stronger legal sense, and so that is the primary advantage. In fact, a note receivable is a promissory note, similar to what you would have if you were to borrow money from a bank, that sort of thing. Okay, so let's look at some characteristics of a note receivable, and this is primarily an exercise in vocabulary. So when we talk about the maker, so the maker of the note is actually the borrower. It says is the party making the promise to pay. And that's something that we probably need to understand, is that when we say that someone issues a note receivable or issues a note, those types of things, we're talking about the maker, and we're talking about the borrower. So often if we borrow money from a bank or something like that, the bank is the one that is supplying the money. The bank is the one who is supplying all of the paperwork that's to be signed and these types of things. And so we think of the bank as being the issuer or the maker, but that is not the case. It is actually the borrower who is issuing the note or is making the note, okay? Even though they're not usually the one supplying or authoring the paperwork. The payee is simply the party to whom the note is payable. So this would be the business that has issued a note receivable, or the bank who has loaned out funds. Number 3, the face amount is the amount that was borrowed, loaned, however you want to think about it. So if we go to the bank and we borrow $10,000, face amount is going to be $10,000. Issuance date, pretty self-explanatory. The due date or maturity date is the date that the note is to be paid. So if I borrow money on January the 8th, that is the issuance date. Let's say that I have exactly 1 year. Well, let's make it a little bit more creative than that. Let's say that I have 6 months to pay that back. So let's see, February, March, April, May, June, July. Date of maturity or due date would be July the 8th. The term of a note is the amount of time between issuance and the due dates. Now, this is something that you're going to really need to pay attention to, because in a lot of our calculation questions that we're going to have, you will have a scenario where we borrow, say for example, $10,000 or $100,000, and we have an interest rate, but the term will not always be for 1 year. In fact, it will pretty much never be 1 year, because we are looking at current assets, and so we're going to be looking at some notes that are going to mature in 3 months, 6 months, that sort of thing. And so the term of the note is how long the note lasts. 3 months, 3-month note, 6-month term note, that sort of thing. And then finally, the interest rate is the amount of interest that you're going to pay. So again, let's think back to that term. If we're going to pay 10% interest on a 6-month note, well, we can do that one of two ways. We can say, okay, 6 months is half a year, so we're going to take half of that 10% and multiply by 5%, or we can just take the amount, multiply it by the interest rate, and then multiply that by 0.5 if we were dealing with a 6-month note term. Okay, is that the last one? I believe it is. So we have kind of a general old school example of a promissory note. We have some of our terms here. Let's just see, where's number one? The maker. This is this H.B. Lane is the person who is borrowing the money. In this case, it looks like it's going to be $2,000. Let's see, we have a payee, Pearland Company. This is the individual who is loaning the money. The face amount is for $2,000. That's the amount of money that selling company is going to receive. They're going to receive this on March the 16th. They're going to be paying this back on June the 14th. Okay. So it looks like this is a 3-month note or a 90-day note. Okay. Term 90 days. There it is right there. And then finally, the interest rate is for this one is 10%. Okay, so all of the things that we talked about on the prior page. So it says characteristics of a note receivable. We're going to compute the interest as follows. Now they borrowed $2,000, so that is the principal amount or the face amount. We have our 10% here. But then notice what we're going to do here. We're going to take 90, which is the amount of time that they're borrowing the money, and for purposes of simplification, we're going to call a year 360 days. You already know that a year is 365 days, but the math comes out quite a bit cleaner if we do it this way. And so if we were to take 2,000 and we were to multiply that, let's just see here. If we were to take 2,000 and we were to multiply that by 0.1 and then multiply that by 90 divided by 360, we do in fact come up with $50. Well, what is this $50? This is interest, just like it says. All right, now this next point I want you to pay a little bit of attention to. By a little, I mean a lot. It says the maturity value is the amount that must be paid at the due date of the note, which is the sum of the face value amount and the interest. Therefore, the maturity value of the note is $2,050. $2,000 face value plus the $50 in interest. So, accounting for the note receivable, it says assume that a company accepts a 30-day, 12% note dated November the 21st in settlement of an account for W.A. Bunn Company, which is past due and has a balance of $6,000. The company journalizes the receipt of the note as follows. Well, first of all, we need to understand what's going on here. This company here, this W.A. Bunn, they have purchased, let's just assume that it's merchandise. And originally we had an account receivable set up, a regular account receivable, and something has happened, and there's been some correspondence here, and so what? Let's see here. It just says a company. Okay, it doesn't give us the name of the company. But what they've done here is they said, you know, we want to get this account receivable off of our books, but we don't want to just forgive it entirely. So they have essentially loaned W.A. Bunn the money to pay themselves back. And so what that does is it reduces or eliminates the account receivable. See, we're crediting the account receivable for the $6,000, but in its place, we're creating an equivalent asset, a note receivable that has a stronger claim. So, reading between the lines here, W.A. Bunn better pay this money back after 30 days because if they don't, they're going to have a fairly strong legal claim against them. Okay, so this is the initial journal entry to satisfy the receivable and to create the, to satisfy the account receivable and to create a note receivable. Now, as fate would have it, W.A. Bunn ends up paying this amount back. It says at the due date, the company journalizes the receipt of $6,060. And we see how they did that here. We took the 6,000 times 12% times 30 over 360, or 1 over 12, however you want to do that. And if we execute that math, we come up with $60 of interest. So what did this company receive? Cash has gone up by $6,060, but we want to understand that we set up this note receivable for $6,000. That's all we can credit it for, the full $6,000. We also have interest revenue of $60. Why is interest revenue a credit? Well, because it's going to show up on the income statement under other income, and just as sales revenue is entered with a credit, so too is interest revenue. All right, and then we have a little small portion of a balance sheet. Okay, very good. So that completes our chapter on receivables. And we're going to have some handout videos for all three portions of the PowerPoint presentation.